Welcome to the Global Pulse, a short video series where our experts break down a trending topic in international business and why it matters to you.
On March 19th, Japan announced the end of its negative interest rate policy that has been in place for 8 years. The Bank of Japan had been charging financial institutions 0.1% on some of their reserves kept with the central bank. Bank of Japan will now pay 0.1% interest on financial deposits that are kept with the BOJ. This represented Japan's first interest rate hike in 17 years. In addition to the negative interest rates, Japan has been trying to encourage economic growth through government spending. Government debt to GDP now stands at about 250%. Why did Japan embark on these policies, the negative interest rate policies and the government spending policies? Well, these policies date back to the inflationary bubble in Japan that burst in 1992. At that time, housing prices peaked and the Nikkei stock market index also peaked. Well, since the 1990s, housing prices have largely declined and by some measures are still below their levels of the early 1990s. Nikkei stock index also declined and has only risen back to its 1990s level during the last year. Real and nominal wages in Japan declined during much of the last 30 years, as Japan experienced relatively anemic labor productivity growth. By some measures, Japan has been ranked last in the G7 in terms of productivity growth over the last 30 years. Moreover, Japan has had negative population growth over the past 15 years. The lower population, declining productivity growth, has led to a deflationary spiral in Japan, where prices and wages have declined and household income levels have also declined. The negative interest rate policy has had some benefits for the Japanese economy. It's kept the Japan yen relatively low as investors have looked to borrow in Japan and then convert the Japanese yen to foreign exchange and take the money out of Japan. The recent exchange rate is about 150 yen to the US dollar. The low exchange rate has helped these Japanese exporters and also encouraged tourists to flock to Japan. Prices for many consumer goods and services are very low in Japan, at least by US standards. But how cheap is it in Japan? Well, on my recent trip to Japan, I stopped by a real estate office and checked out the prices for one-bedroom apartments. In Higashi, Hiroshima, which is a college town where Hiroshima University is located, you can rent a one-bedroom apartment for about $300 a month, much lower than the rental prices in College Park, Maryland. Well, why has Japan decided to change its negative interest rate policy? Well, recently, some of the Japanese workers have been getting relatively higher wage increases at around 5%. And so Japan finally is believing that, in fact, it's a deflationary economy, maybe turning around, and that wages and maybe prices are going to be picking up. So it needs to increase interest rates. Will this policy work to spur the Japanese economy? It's not clear. The higher interest rates could increase the value of the yen, making Japanese exports more expensive. Consumer spending and business investment could also decline with higher interest rates. Until the Japanese are able to increase productivity and real incomes, the economy may be in for a rough ride.